The stock market had a quiet day today as it digested more coronavirus news, more earnings, but what we did see was additional all-time highs from an intraday basis on both the S&P 500 and the Nasdaq Composite. We also saw that the Russell 2000 kind of led the way higher today from a percentage perspective and has been making some nice progress recently above its rising moving average. So we'll take a look at all of that, see what it means for our posture. We'll then get into our trade application example on a stock that just raised its dividend here this afternoon. So with that, let's go ahead and get started. Welcome to the Market Outlook video presented by MarketScholars.com. I'm your host, Brandon Van Zee. It's February 13th, 2020. First of all, if you're new, welcome aboard. Remember to go over to YouTube, click subscribe. While you're over there, check out our description area where you can sign up for our email distribution list. We're also heavy users of Twitter. Feel free to follow me. My handle is @BrandonVanZ, and we appreciate those of you that click like and retweet. Lastly, we do have a presence on Facebook as well. Feel free to join us at the group at the web address embedded in the logo in front of you. All right, let's go ahead and jump into our charts. As you can see, I've got chart 4B pulled up here in front of us. This will give us a general sense of what happened with the four major U.S. equity indices here, at least in the United States today. And as I mentioned in the intro, we did get a new intraday all-time high on the S&P 500. So our new bogey is 3385 as far as all-time highs go. We also got an intraday high on the Nasdaq Composite, which was 9748. However, both of those ended up slipping just a bit by the close. You can see the S&P 500 was down 0.16% today. Nasdaq Composite was down 0.14% today. So while they did achieve new all-time intraday highs, they weren't able to quite achieve all-time closing highs. Now, I also noted in the intro that we've been seeing a little bit more stability out of the Russell 2000 here recently. Wanted to point out that there was a bit of a bullish engulfing candle here. You'll notice that it was by far and away today's leader. It was actually the only one of these four that was actually up on the end of the day. It was up 0.26%. You'll notice that for the last 2 or 3 sessions, that moving average below it has been painted green, which basically is a reminder that price is now above a rising moving average, and that had not necessarily been the case here for the last month or so. So some good progress there with the small caps here in the United States. Couple other things I'd point out before we move on to our next chart is, first of all, we didn't have a big range today. You'll notice that these labels here on each of the charts is blue as opposed to orange, telling us that today's daily range was smaller than the average true range. And then also wanted to point out that we have a couple of bullish intermediate confirmation signals, but neither one of them would be considered ideal. So the first one would be on the S&P 500 itself, and it just barely was able to accomplish it. Remember, the bullish intermediate confirmation signal is a way to try to locate stocks, or in this case, indices that are in uptrends but have a momentary pullback. And so we're looking for the green line or the intermediate line to give us a bullish posture, which, remember, anytime it's in the upper reversal zone like it is right now on the S&P 500, that's considered bullish. And then at the same time have that red line in the lower reversal zone. Now, this one is really hard to see with the naked eye, so that's why it might help you to rely upon these labels that we provide for our premium members here. You can see that the momentum line is at 1993 and falling, and so since that is just a hair below 20, technically that counts. Now, as we've mentioned many times in the past, there are more ideal signals and less ideal signals. The more ideal signals occur when we have enough of an exhale that the blue line finds itself between 50 and 20. So while it's not part of the actual signal, we've just found from using our own experience that the signals are more valid if that can also be part of the setup. And so right now with the blue line still way up here in the upper reversal zone, we haven't had enough of an exhale there to make this give this a good feel for a true buy the dips mentality. Yeah, we were down a little bit today, but it's not like we're getting extreme value or anything like that. So I think a lot of people would probably say, okay, it's interesting, but not really actionable at this point. And same thing can be said for the Dow Jones. It also received a bullish intermediate confirmation signal with a bullish intermediate line and then red momentum line in the low reversal zone. But again, that blue line is still way elevated there. I think a lot of people would like to see more of an exhale. You get some of these candles coming down here closer to that rising moving average. That then would push that blue line down into that area there. So we're going to keep our eye on that. It does look like we're kind of setting up for some possible near-term bearish divergences. The reason I say that is you can see here on the Dow Jones as an example that we had this peak number 1 on the near-term line here, and it was lower on the next peak, which would have been associated with this candle here, yet the prices went up at the same time the indicator went down. So that is not a, sell everything you have and, go fully to cash type of a situation. It's just, again, be aware of it. We try to point out these things as we see them. And right now that's maybe one of the flies of the ointment here. Obviously, we've had a really, really good bullish stretch for several months at this point. So I think a lot of people are just kind of waiting for a more serious pullback. Yeah, we had a little bit of one, back here in late January, but remember that wasn't even 5%. Usually we have multiple 5% pullbacks per year, and so it's been a while since we've had one. We'll keep our eye on it, and when we start seeing some of those being established, of course, we'll keep you posted here on these market outlook videos. All right, let's go ahead and take a look at our next chart setup now. This will be our 3 green arrows chart setup. This is chart 4D for those of you that are following along at home. And wanted to point out that there wasn't a whole lot of change here, so we're not going to spend a lot of time on this. All 4 of our major U.S. equity indices continue to have a 3 green arrows signal at this point. Remember, 3 green arrows comes from the 3 different technical indicators that you see on the screens in front of you, including the 30-day moving average. When price is above it, you get a green arrow. The MACD histogram, when the reading is above the 0 line, you get a green arrow. And then the stochastics, and there's a couple of ways you can earn a green arrow on the stochastics, either a physical green arrow, which I don't have an example of. Actually, I do. Down below here on the Russell 2000, this was actually a physical green arrow because the stochastics reading came down below 25 and then emerged back above it. So that would be an example of a physical green arrow right there. Whereas something like the S&P 500 here, this would be known as a phantom green arrow, where the stochastics was going lower, didn't quite reach that lower reversal zone, and then reverse course before then. So with these customized charts that we use here, we do have our ThinkScript programming that allows us to see even the phantom green arrows. Again, if you are a premium member of Market Scholars, you have access to all of these charts that David and I use. So not a whole lot to report here. Still 3 green arrows across the board, and therefore still a very strong trend trading environment. In fact, out of the 4 trading rooms that I teach for my premium members, it's not even close. Right now, the trading room that's doing the best in 2020 is the top-down trend trading class. It's just like daily gains upon gains upon gains. So this is a really strong kind of momentum-oriented market that we find ourselves in, and one where trend traders have been really winning the day. So if you're interested in that concept of top-down trend trading, be sure to join me on Mondays and see if we can keep our hot hand alive here in the coming weeks as well. Of course, this next weekend is a little bit different since we've got President's Day coming up here in the United States, and so with the market's observance of that on Monday, the stock market's not open, and therefore we're not going to be teaching our classes either. But normally on Mondays, you're welcome to join me for that class, and it's been a really, really good run of things that we've had here recently. All right, let's go ahead and now take a look at our next chart setup. Let's pop on over to some of these 12 grid analysis now, starting with chart 5A. And so a reminder that when we're looking at these 12 grids, the background color is going to tell us whether we have a bullish posture or a bearish posture. And then the different shades of green and pink will tell us whether those postures are strong or weak. And so we do have examples of all 4 of those possible conditions on the charts in front of them. So perhaps we can start with the top 3 on the board, starting with the chart in the upper left. That's the S&P 500. This represents U.S. stocks from a large cap perspective. Notice the dark shade of green right there. That represents a strongly bullish posture. We've got the intermediate line on the market forecast at 93. It is falling, but remember, as long as it's above 80, we consider that to be strongly bullish. If it were to fall below 80, then we start changing our posture. So right now, obviously, this is a very, very good looking chart. Starts in the lower left ends in the upper right and not a whole lot of volatility along the way. So if you've been long the US stock market for the last 3 months, you've probably been blessed with some gains in your portfolio. As we advance our thoughts now to the right, you can see we've got a different background color here. In this case, it's that light pink color. And that light pink color appears when we have a weekly bearish posture using that market forecast intermediate term line. And so right here, the intermediate line is at 66.20 and falling. And so obviously that is below that upper reversal zone that I mentioned before at 80. So 66 is below 80. And because it's falling, but yet not down below 50 yet, we still consider that bearish, but just not strongly bearish. So this is weakly bearish at this point. And that makes sense. I mean, we don't want to call this out and out ugly bearish because right here, EFA is trading basically at its moving average. Yes, it's not going up at the same rate as the S&P 500, but at least it's not plunging at the same time. So it's a weekly bearish posture for now, but that could flip right back to bullish, within a couple of trading sessions if you had some strength and you put it back above that moving average. In terms of the emerging markets, this is worth pointing out. We now have a weekly bullish posture on the emerging market stocks. Notice that background color there is light green. And again, similar to the developed foreign stocks, these emerging foreign stocks are trading somewhat near the moving average itself. But because there's been a bigger rebound in recent weeks, notice how low EEM was back here on January 31st and to jump all the way up here, that's a big percentage move, whereas there hasn't been as big of a percentage move in the developed markets yet. So anyway, right here you'll see that the intermediate line is at 48 and rising. And remember, if that intermediate line goes above 50 and continues to rise between 50 and 80, this background color of the chart will switch from light green to dark green. And then you can see down below, if we want to kind of also get an example of something that would be considered strongly bearish, notice these two charts in the lower right-hand corner both have that darker shade of pink, signifying strong bearish posture. And that occurs when the intermediate line is falling somewhere between 50 and 20, or just simply in the lower reversal zone at 20 or less. And that does represent both of these in the lower right-hand corner. Oil is at 8, and the 10-year U.S. Treasury yield is at 18. So both of those would be considered to be in the lower reversal zone and therefore strongly bearish. And it should be pretty obvious why that's the case. You look at the charts and you'll notice that the price candles are down significantly. And while both of them have been trying to establish some sort of a support or some sort of a bottom, you're just not able to quite get that progress that you want to see, at least if you're looking for stronger trends. In terms of any other charts that are catching my eye out there on this set of 12 grids, the real estate area remains very, very strong. So we've actually had 4 straight up sessions and fairly significant ones as well for VNQ, which is one way to track the REITs. And that was a really nice bounce off of that kind of rising 30-day moving average level at the end of January and has been kind of full steam ahead since then. Let's take a look at our next chart setup now. And this one will be chart 5C. This will be our U.S. sectors 12 grid. So give us a sense of what's going on here in the United States. Now remember, I do the sector selector tool for my premium members on the weekends. That is built specifically for my Monday top-down trend trading class. I will plan on putting that together tomorrow night like I traditionally would, but again, want to stress that there won't be any class on Monday because the stock market will be closed in observance of President's Day. Anyway, this will give us a general idea of how these various sectors are doing, at least from the S&P 500's perspective, over the last 3 months or so. And you can see there's a little bit more of a mixed bag that we're dealing with here. We're getting more neutral conditions out of healthcare here, whereas we're actually getting legitimately bearish conditions out of energy, and then weekly bearish conditions out of materials. So materials just here a couple of days ago was actually bullish, and then here we are today back to weekly bearish. So just be aware this one's kind of oscillating back and forth between bullish and bearish. With it still trading above its moving average, I think that that's some positive development there, but it's just not the greatest looking chart clearly. When you look at those green charts on the board, there you actually have some pretty outstanding trends that are taking place. Communications right up here, second to the right on top, and then technology all the way in the corner up at the top right. Both of those have been excellent, and those two have been 2 out of the 3 leading sectors in recent weeks on my sector selector tool, and it should be fairly obvious when you look at that chart why that's the case. I mean, these are very strong trends that are in play here for both communications and technology. And then the third one that's been in that top 3 ranking in recent weeks has been utilities, which is down below. And just when I thought maybe utilities would have a little bit of a give back there, some of you might recall we did a bearish trade on one of the utilities about a week or 2 ago. It doesn't look like that one's going to pan out. The trade's not over, so we won't know for sure. But it's looking like this is turning into a continuation move right here as well. And by the way, that's part of the reason my Monday top-down trend trading class has done so well in 2020. 6 out of our 25 positions are utilities, and you usually don't think of utilities as strong trending securities, but they absolutely are right now. That is quite the extraordinary move that they've been on since just the beginning of the year, which would have been effectively right here on the chart. You can see how much progress utilities have made along the way. Real estate has been making quite an impressive run of things here this week as well. One thing that I am anticipating right now, we'll see if this comes to fruition or not, but when I put the sector selector together tomorrow night, right now, I'm assuming real estate will be making some waves to the upside because that is a really, really strong move this week. And while some of the other categories have gone up, they haven't gone up at quite the same rate. So we'll see tomorrow night if that is the case. But right now, I am making an assumption real estate is going to be working its way up in the ranking system. I don't know if they'll make it all the way into the top 3 because it's hard to kick the communications, technology, and utilities out of the top 3 because they continue to do very well. But real estate might find its way all the way up to number 4. We'll just have to see how the rankings shake out. But right now, I have been quite impressed with a lot of those real estate investment trusts that have been working, especially the cell phone tower REIT companies that I mentioned in the presentation on Tuesday. Real quick over here on the internet, just wanted to say thank you to those of you that clicked like for me the last time we did the video. Remember, I try to get these videos done and out to you fairly early. Each time I do the video, I just saw a comment on Twitter for somebody else that said, I'd like these videos if they were done before I go to bed on the East Coast. And this came from somebody who didn't really like the videos all that much to begin with. So I want to remind you that when I do the videos, I usually try to get them done early for you. So if you do actually appreciate that, be sure to click like. Don't just say it. Actually do it. But 106 of you did that the last time around for me, and I appreciate that. So we'll make sure we make this a full-length video. If you want me to do another full-length video on Tuesday, the next time I do the video, make sure you click like on the next tweet that I put out there that represents this video. If you don't want me to do a full-length video, if you prefer the shortened 15-minute version, then don't do anything. Don't click anything because if it's over 100, we'll do the 30-minute version. If it's under 100, we'll just do a 15-minute quicker version for you. All right, back on track with our charts now. Let's go ahead and take a look at our global stocks, the primary 12 grid here. So this will be chart 5E for those of you that are following along at home. Here you can see it is a much, much different story than what we are witnessing in the United States. The United States by far and away is the stronger area of the globe right now, at least from a stock market perspective. You can see that we've got a few green charts on the board. The ones with the deeper shade are going to be down below here with Canada and South Korea. But when you compare those two to the S&P 500, which is the one in the upper left, you can see that the S&P 500 still looks stronger than even those two that are considered relatively strong compared to a lot of their competition around the globe. So Canada looks okay, but even there you've got a little bit of a double top. Now remember, this is based in US dollars, so if you're watching this from Canada, which we have a lot of Canadian viewers, which we appreciate, your chart may look a little different in Canadian dollars, but nonetheless, the U.S. market probably looks like a stronger trending market right now. And I would say the same thing with South Korea, even more so here. South Korea is actually just hanging on by a thread to that position above its moving average right now, whereas it's not really that close to its high that it put in back on January 16th. So while those two are considered above average compared to other international markets, they still are not quite as strong as what we're witnessing here in the United States. In terms of some of the weaker markets out there, you can see that down here on the bottom rung, you're going to see Brazil with a strongly bearish posture. And you can see that it is below a falling moving average as well. So notice that the tip of the moving average is red, and the same thing can be said over here with Russia. So both Brazil and Russia have the darker shade of pink, and both of them have the red moving averages there, signifying that the path of least resistance right here, right now, is still down, not up. And so if there's some of you out there that think that, where our markets are going to kind of stall out here going forward, maybe your, hypothesis is that the coronavirus is going to continue to expand across the globe and it's going to shut down economies all over the place, then one approach would be to, kind of kick them while they're down, so to speak, in terms of what are the weakest charts around the globe and short those particular charts, or short individual stocks within Brazil or Russia, or do bearish options trades or what have you. And so those are the two areas of concern right now, Brazil and Russia, from a major economy perspective. Let's check some of the secondary economies now. And this will be chart, let's see, this is going to be 5G right here. All right, so as we pull these up, you can see that the secondary countries actually are a little bit more resilient. Their charts are a little steadier than the major economies around the globe. Now, you still have some disturbances here, so don't get me wrong. The chart's kind of in that middle rung there, whether it's Indonesia, Turkey, or Saudi Arabia. Those still look pretty lousy with strongly bearish postures. But the rest are actually green. And so from that perspective, some of the smaller nations that don't get as much press are actually hanging in there a bit better from a stock market perspective than the major nations that are out there. In terms of which ones look the best from a trending perspective, to my eye, I'd probably put Mexico on that category. So EWW is how you can track Mexican stocks. And that's a fairly solid trend. Again, it's not as strong as the United States, so don't get me wrong there, but at least we can say that the chart is trending in the right direction, starting in the lower left, ending in the upper right, and currently residing above a rising 30-day moving average. So it wouldn't really take much for Mexico to break out to new multi-month highs. The bogey in this case would be back on January 22nd. So that's one that I would point out. Another one that looks fairly promising is down below here. This is Switzerland. So whether you're trading an individual stock like Nestle, or whether you're trading the entire Switzerland stock market through something like EWL, that's a pretty strong chart right there. Steady eddy to the upside, somewhat similar to the S&P 500 from that perspective, where there really hasn't been a lot of givebacks along the way. They've been fairly strong to the point where really there was only one time that it closed below the 30-day moving average, and that was on January 31st. That's briefly where we got that moving average changing from green to yellow. Otherwise, this trend in Switzerland has been so strong that the traders have had a really hard time pushing it below its moving average. And that's usually a good sign for trend trading opportunities that are out there. And then last but not least, I'll also throw Sweden in there as kind of an honorable mention. I don't think its chart looks nearly as smooth as what we saw out of Switzerland, but EWD did have enough of an oomph in the last, let's call it week and a half to 2 weeks, to push us up here very close to multi-month highs. So let's keep our eye on that story there as well. So kind of interesting. I'm glad we looked at that, because that's not what I was necessarily assuming before looking at these charts, but there does seem to be a distinction right now between the major economies of the world versus some of the minor economies of the world. And right now, surprisingly, it's actually the minor economies that are holding up a bit better from the stock market perspective. All right, so with that out of the way, let's now get into our trade application example for tonight. And as I mentioned in the intro, I wanted to talk about a stock that just this afternoon raised its dividend. It wasn't a major increase. Some of you saw me talking about on Twitter yesterday, a kind of a jaw-dropping number that we saw out of T. Rowe Price. That raised its dividend 18%. I was definitely not expecting that. So this one that I'm going to refer to is not going to be nearly as extraordinary from the dividend increase perspective, but nonetheless still noteworthy. And the stock that I'm going to refer to is UPS. Now, Pepsi comes up automatically on this particular chart, and Pepsi also raised their dividend today by I think it was 7%. But UPS raised their dividend just this afternoon by 5%. And has been a stock that has not kept up with a lot of other elite dividend-paying companies out there. This is the 11th straight year of dividend increases for UPS. But remember, even prior to that, they kept their dividend steady during the last financial crisis of 08-09. They were not one of the dividend cutters out there. They just kept it at the same rate. And so their streak had to start over afterwards just because they kept it steady. So anyway, I give them a little bit of bonus points for that. They didn't cut that dividend any time in recent history, including the 2008 and 2009 crisis. Obviously, UPS needs no introduction to most people, especially those in the United States. It's one of the world's foremost transportation companies and delivery companies, and they still have a relationship with Amazon, unlike their direct competition of FedEx, who kind of pulled out from Amazon more recently. So UPS is a little bit of a play on e-commerce to a degree, yet they really haven't been given the benefit of the doubt. As you can see from the stock price, it's largely just been slop and chop sideways in recent years. This is a 10-year chart we're looking at here. And where we stand right now with the dividend before today's announcement is a 3.65% yield. That does not include the new rate going forward that was just announced after the bell tonight. So one thing that I wanted to kind of talk about today was the new calculation, and then base that off of the theory of us potentially getting put this stock at a lower price. So first of all, let's talk about the sold put trade itself. And what I was targeting was going to be the 100 strike in March. And so you can see right here, the March monthly contracts, the 100 strike is going somewhere between $1.17 and $1.31. So we are over 1% return on risk there. Let's go ahead and try to get filled at, I don't know, let's try to do 120 just to have a round number there. We should probably get a little bit better fill price than that because it'll be in the mid of 117 and 131. So let's try to get filled at 120. And I will put this in as a good till cancel. So that way if we don't get filled tomorrow, it'll still work for us in the days after that. So I'm going to put the trade in first, and then we're going to talk about the yield that would be acquired if we were put that stock at that level. So let me just go ahead and fire this off. So remember, I'm taking $120 in for my willingness to buy 100 shares of UPS at 100 if it closes below 100 on the March expiration date. So $120 is mine to keep until then, and if it does go below 100, I will plan on buying it because I think it's a pretty high quality company for a long-term portfolio, and I don't happen to own UPS in this particular paper money account yet, so I think it would be a good fit there. Now, with the trade itself out of the way, I did want to discuss an additional concept because sometimes I get asked about how to actually calculate yields and how to think about these things. So first of all, remember, if we are forced to buy it, our cost basis will be our strike price minus the credit that we receive, which will be $1.20 if we get filled on that trade. So our cost basis would be $98.80. Now again, the new dividend increase was just announced this afternoon after the stock market closed. They raised it from 96 cents, which you can see right here on the Thinkorswim platform, to this new number that you see over here in the headline of 101, and that's a quarterly basis there. So let's calculate that as well. If we were to get our calculator out, we take the new rate of $1.01 and we annualize that by taking it times 4. Since those are quarterly payments, the new annualized dividend amount will be $4.04. So now that we have that number, let's divide it by what our expected cost basis will be if we are forced to buy 100 shares after our sold put. So that number again was $98.80. 80 cents. And therefore, our yield on cost with UPS would be over 4%. So it's important for you to be able to calculate those things on your own, because that's a mighty big difference between what the platform is telling you right now of 3.65% versus what your actual yield will be if you're forced to buy it through the sold put itself. Your yield will start off over 4%, and that is mighty handsome in this market. Most of you are aware the S&P 500 is only yielding 2% at this current juncture. So hopefully that helps you understand the process of calculating yields a bit more as well. All right, well, thank you for joining me here tonight. Once again, the stock market is in a bullish posture mode, but we had a little bit of a pullback in the S&P 500 and the NASDAQ today. Did have a few of those bullish intermediate confirmation signals, but they weren't ideal setups. However, there are still interesting developments out there, including stocks like UPS that are raising their dividends this time of year. Perhaps those of you that are long-term oriented will find something to like even through selling puts there. So if you got value out of tonight's video, I encourage you to go over to Twitter and click like, especially if you want me to do another full-length video next Tuesday. Remember, David will be back with you tomorrow, and then we won't have any video on Monday next week due to the holiday weekend. So with that, I want to wish you all the best of success with your trades and your investments. Goodbye for now.